All right, welcome. Today we're going to dive into a question that's really at the heart of investing, business, and, maybe even your own financial choices. It sounds like a simple question about value, but the answer, well, that's where it gets tricky.
So let's just jump right in. How do you put a price tag on something that hasn't even happened yet? How does a company decide if, say, a $12 million project is a good move? It all comes down to valuing the future today. And to really get how that works, let's start with something a lot simpler. I want you to forget about stocks and spreadsheets for just a second. Picture this. You're at a nursery and you're looking at a young fruit tree. That price on the tag? It isn't just for the wood and the leaves you're seeing right now. Nope. You're actually buying something more. And that is the key. You're buying the potential for all the apples or peaches or whatever fruit that tree is going to produce over its entire life. The real value isn't what it is today, it's in the promise of that future harvest. But this creates a really interesting problem. So why is that? I mean, an apple's an apple, right? Well, think about it. You could eat the apple today, or you could sell it and invest the money. You know that old saying, a bird in the hand is worth two in the bush? Well, an apple in your hand today is worth more than one you have to wait a whole year for. This super simple idea is called the time value of money, and it's the puzzle we have to solve to figure out our tree's true worth. So, how do we solve it? What we need is a special kind of tool, something like a future fruit detector that lets us look into the future, see all the fruit our tree is going to give us, and then figure out what all that future fruit is worth to us right here, right now. And in the world of finance, that tool actually has a name. And there it is, discounted cash flow. That's the official textbook definition. It's a method to value an investment based on the money it's expected to make down the road. It sounds a little dense, I know, but it's really just our fruit tree analogy all dressed up for Wall Street. A better way to think of it is like this. DCF is your tool to tell the difference between a fantastic investment, our juicy apple tree, and a bad one, a cactus that might look cool but is never going to give you any fruit. It helps you see the real value before you put your money down. So let's see how this thing actually works. All right, now we're going to peek under the hood a little bit. We're going to translate our simple apple analogy into the actual numbers and the steps that analysts use every day. But don't worry, it's a really clear and logical process. So there are really just four main steps here. First, you have to estimate how much cash or, how many apples you think you're going to get each year. Second, you pick something called a discount rate, which is just a fancy way of saying how much less future apples are worth to you. Third, you do the math to discount them. And finally, you just add it all up. Simple as that.
Okay, deep breath. Here's the formula. And I get it, formulas can look pretty intimidating, but stick with me for a second. We're about to make this make perfect sense, because every single one of those letters is just a placeholder for the simple ideas we've already talked about. Let's translate it back into the language of our fruit tree.
See? Look how simple that makes it. CFT is just the cash flow, or the number of apples you get in a certain year. T is just time, how many years you have to wait. And R, that discount rate, you can think of that as your impatience number, or in business terms, the risk you're taking. It's basically how much more you value an apple today over one next year. That's all the formula's really doing.
Okay, so let's leave the orchard and get back to a real business decision. Imagine a company is thinking about spending $12 million on a new production line. Is that a good bet? Well, DCF can help us find out. So let's just walk through this table. In year one, the project is supposed to bring in $1.5 million. But because we have to wait a year, its value today, using a 6% discount rate, is only about $1.4 million. And look at the effect of time. That $5.5 million they expect in year 5 is worth way less in today's money, only about $4.1 million. That's discounting in action. So when we add up all those discounted values, we get the total present value of all the future money, just over $13.4 million bucks. That's what the entire future of this project is worth in today's dollars. But remember, it costs $12 million to even start it. So what's the verdict? And here is the final crucial step. We take that total present value, the $13.4 million, and we subtract the initial $12 million cost. What's left over is called the net present value, or NPV. And since our NPV is positive, more than $1.4 million, the model is screaming, this project is a great bet. It's a green light. And right here you can see just how powerful NPV is for making a decision.
At a $12 million cost, the project adds value. But if that initial cost were to creep up to $14 million, look what happens. The NPV flips negative. All of a sudden, those future earnings are not worth the price of admission. The decision goes from a clear yes to a definite no. It gives you a really simple, data-driven cutoff point. So DCF kind of seems like a magic bullet, right? But it's so important to remember that it's just a tool. And like any tool, it has its strengths and its weaknesses. It is definitely not a flawless crystal ball.
So what makes it so popular? Well, for one, it's incredibly versatile. You can use it for almost anything, from a tiny local business to a massive corporation. It also gives you a clear financial thumbs up or thumbs down and lets you test out different what-if scenarios. But most importantly, it's all built on that fundamental truth. Money today is worth more than money tomorrow.
But, and this is a big but, here's the catch. The biggest weakness of DCF is that it runs on educated guesses. You have to estimate future cash flows and the discount rate. And if your assumptions are off, well, your final valuation is going to be off too. As our source material puts it so well, if you get your inputs wrong, you might just end up valuing a cactus as if it were a fruit tree.
So after all of that, what's the big takeaway here? What should you really remember about discounted cash flow? Ultimately, DCF isn't just about the math. It's a way of thinking. It's a framework that forces you to look past the price tag of today and really systematically evaluate the promise of tomorrow. It gives you a disciplined way to put a price on the future. And that leaves us with one final thought. We've seen how this tool can value a multi-million-dollar company project. But what if you applied that same logic, weighing an upfront cost against discounted future benefits, to your own big life choices? You know, a new career, going back to school, a major purchase. How might that change the choices you make? It's something to think about. Thanks for joining us for this explainer.